sit back and relax. You're listening to episode 269 of the WealthTech Today podcast. I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. And this podcast features news, information, and updates all around wealth management technology. And this is our December news update, or roundup. And I apologize, we missed last month's news. Just the month went by so fast. So this is a double episode of news. We got all the November news and the December news. So it's going to be a long episode. So hopefully you hang in there for all of our stories I'm going to cover. Now, first up, let's see. I got 1, 2, 3. I got 6 stories here, or 7. 6 stories plus our WealthTech map and the WealthTech integration score. So doesn't sound like a lot, but I'm going to go pretty deep on some of these. So I hope you appreciate the content here. All right. First story in the news from last month. Robinhood to acquire Trade PMR. Robinhood Markets has entered into an agreement to acquire Trade PMR, a custodian and portfolio management platform for RIAs. With over 25 years in the industry and over $40 billion in assets under administration, Trade PMR will enhance Robinhood's offering for customers by delivering a top-ranked RIA custody and portfolio management platform that connects financial advisors to a new generation of investors. Now, what's the context here? So Robinhood revolutionized retail investing by introducing commission-free trading and making investing accessible to millions of younger investors. Since its founding, the platform has grown to serve over 24 million funded accounts, with approximately 75% of its users being millennials and Gen Z investors. The RIA custody space has traditionally been dominated by established players serving professional wealth managers. Now, Trade PMR, founded over 25 years ago, has built a reputation for providing high-touch service and innovative solutions to independent RIAs, amassing over $40 billion in AUA. The wealth management industry is anticipating a massive generational wealth transfer, with an estimated $84 trillion expected to change hands over the next 2 decades. This demographic shift has created new challenges and opportunities for both traditional advisory firms and digital-first platforms. Now, Robinhood announced this agreement to acquire Trade PMR for approximately $300 million in cash and stock, with the deal expected to close in the first half of 2025. The acquisition includes all of Trade PMR's custody platform, its network of approximately 350 RIA clients, and preservation of their existing clearing relationship with Wells Fargo Clearing Services. Now, why does this matter? This acquisition represents a significant shift in the wealth management landscape, marking Robinhood's strategic entry into the $7 trillion RIA market. The move bridges the gap between digital-first retail investors and traditional advisory services, positioning Robinhood to serve its maturing customer base as their wealth management needs evolve. Now, according to the press release, this strategic acquisition brings together 2 mission-aligned companies as Robinhood enters the wealth management space, combining the skills of fiduciary advisors with Robinhood's cutting-edge technology. Now, it's not all rainbows and unicorns here with this deal. There's a lot of people talking about it. There's been a lot of very, very smart people making some comments, and I'm going to read a couple of what I found the most interesting comments about this acquisition. First was from Rex Salisbury, angel seed fintech investor and former partner at Andreessen Horowitz, and Rex posted this on LinkedIn. Robinhood's core customer today is retail investors, of course, who have less than $1 trillion in investable assets. So that's his point, that Robinhood has done a remarkable job monetizing, way better than most people thought possible, given that they have zero commission trading and rely mainly on payment for order flow. They have about $100 average revenue per user off 25 million customers, despite those customers having only a $6,000 average balance. So Rex calling it 160 bips on AUM. So if you're doing the math, that means they have 140 billion in AUM and doing about 2.5 billion in revenue. That's Robinhood. However, as Rex points out, the RIA world is much larger than 100 trillion in assets. The advisor usually charges 1%, but that's not what Robinhood would do. They would be the custodian and technology layer where you can typically monetize to the tune of 15, 20 basis points, which is a lot less than 160 basis points. But the amount of assets is way bigger. 100 trillion in assets at 20 bips is $100 billion in annual revenue market. Or I think it's 200 billion, isn't it? 100 trillion at 20 bips is 200 billion in annual revenue. So it's going to be a hard market to execute in for Robinhood. It's probably 2 to 3 years of learning to develop 2 to 3 years of product roadmap. The $300 billion purchase of Trade PMR is basically a way to learn what this would look like to enter. And for that reason, it makes a ton of sense. And in his opinion, it's a bargain. It's still going to be a long, hard road. However, they're led by an ambitious founder. They have great tech talent. And also they're a custodian already, which is huge. Trade PMR is technically not a custodian. They're reselling Wells Fargo custody. So think of them as tech on top of custody. In Rex's opinion, who's the biggest loser? Well, Wells Fargo First Clearing. Since they have that 40 billion in assets, that's eventually going to go away to Robinhood's platform, which we all think they're going to be building. And Rex thinks that this could also impact the other incumbent RIA custodians in the long run, that more firms are going to look to do something similar and try to, being pecked to death by ducks, slowly eat away at the big custodian's lead, which is going to take a while. So I'm not sure if Rex is right there, but he's got a 10 to 15 year outlook. The biggest winner, in Rex's opinion, is Altruist. And we're going to get into Altruist in just a minute. So what are the implications for advisors? For RIAs, this acquisition promises new opportunities to access Robinhood's massive millennial client base through a planned referral program. Trade PMR advisors will strive to maintain, I hate these press releases, strive to maintain their existing service levels and clearing relationships while gaining potential access to next-gen investors who may be seeking professional guidance as their portfolios grow more complex. Not so sure about that. The needs of Robinhood customers are evolving, and they claim to be seeking advice on how to build and manage their growing portfolios, or rather Robinhood claims they're looking for that kind of advice, and that's driving part of this deal. So let's see another industry expert or industry voice talking about this deal. Stephen Levinson, Enterprise Account Executive at Clearwater Analytics. One of the most pressing issues facing the merger is the stark contrast in corporate cultures. Very true. Robinhood's reputation for gamifying trading and its past compliance issues may leave RIAs wary of the brand. Yep. The merger calls into question whether Robinhood can effectively integrate its innovative tech-driven approach while respecting the more traditional and cautious ethos of Trade PMR's RIAs. That is true. So Robinhood and Trade PMR plan, according to the press release, to build a best-in-class referral program with new client acquisition being a top priority for most RIAs. They believe Trade PMR's clients will be able to access a new client base through Robinhood. Following the close of the deal, the two firms intend to enhance their technology platform to make it easier for RIAs to reach Robinhood customers and grow their business at scale. I wonder if anybody asked Robinhood customers how they feel about this. Hopefully Robinhood did some research, some internal marketing or market research to figure out, hey, you guys, do you really want the RIAs to be calling on you and bugging you to sign up with them? Now, I know I told you that we're going to talk about Altruist, and I posted some stuff on LinkedIn and Twitter, and Jason Wenk, the founder and CEO of competing custodian Altruist, replied to my post about the best-in-class, I'm using air quotes, referral program that they plan to build. I'm assuming, okay, so Jason said, I feel sorry for anyone who believes this, referring to the best-in-class referral program. It's a distraction, so advisors stay a while they build out their own advisor platform from scratch. They won't keep any tech they bought or Wells First Clearing, according to Jason, and then move the advisors in 2 to 3 years. So he wrote, Jason then wrote a very long LinkedIn post, which I encourage you to read. I'll put a link in the show notes. I'm just going to read a couple points from his post. So Jason believes that Robinhood plus Trade PMR will eventually run circles around Schwab Advisor Services, but not before about 40% of their RIA clients bolt to other custodians. Now, of course, that didn't play well with Trade PMR folks, and they clapped back a bit about that because that clearly wouldn't be a good thing for them. Jason included Altruist as also running circles around Schwab, but of course, he wasn't predicting any market share loss for his firm. Jason also said, I'm not buying the press releases in most of our industry journals talking with consultants who don't really know what they're talking about. That's true. I got to tell you. After that, the Robinhood team will start learning from Trade PMR, according to Jason. They'll need to learn all the nuances of serving RIAs, of which there are many, account types, investment products, integrations, building a new advisory platform, building everything digitally and on paper, and also having actual humans available on phone with deep understanding of the RIA business model, which may someday be replaced by AI. But right now, you need people. So Jason's basically saying, look, we built this over the past 10 years, and you're going to have to do the same thing we did. Maybe they can learn and build it quicker. All of this learning will turn into a product roadmap that will require 2 to 3 years of development, according to Jason. Until then, existing Trade PMR advisors will likely feel very little impact. Around the same time, they'll notice existing Trade PMR users, and they will be migrating to Robinhood for custody and clearing. I suspect the platform will be really solid, but still not quite as robust as firms that have been building RIA custody for decades. Alltrust will be 8 years old by then, for example. Zoom out 5 years, and Robinhood will be one of the more compelling RIA custody platforms in the industry. And also, Jason put a poll on LinkedIn, got 472 votes, asking advisors, would you move your clients to Robinhood as an RIA? 89% said no. Wow. So that's just pre-deal, pre-marketing, just based on people's gut reaction. So not sure if what you can consider if that's valid or not. Still 472 responses is pretty decent. Josh Brown, CEO at Ritholtz Wealth Management, jumped into the fray. Josh said, the real question is who pays for this or what pays for this? Advisors aren't frequent traders, nor do they do a ton of options. So payment for order flow, which is how Robinhood makes most of their money, is not going to be anything special, and margin balances will be low relative to existing Robinhood retail. Yeah, and Josh gave a menu of choices for how they're going to pay for this deal. A household fee, a suite of asset management funds that advisors are strongly encouraged, in air quotes to use, or an in-house bank money market sweep a la Schwab, or all of the above, plus a dollop of crypto stuff. That could happen. Back to Jason's comments, the best parallel to Robinhood would be E-Trade. I thought that was an interesting observation, that when E-Trade got into the business, they were mostly small accounts, active traders with modern tech at the time. And their RIA custody business was a flop for them. And referrals from their active trader channel to RIAs never materialized because basically those customers are active traders. They don't want advisors. They think, so Jason thinks Robinhood's a much better company than E-Trade and will figure it out, but it'll take around 5 years. So why does he think they're running circles around Schwab? But he's not going to lose any revenue or market share. So ultimately, it'll be a far lower cost to advisors to use Altruist, and clients should be able to get better outcomes, less cash drag, lower costs, access to fractional shares, automatic tax location, and tax loss harvesting. And there will be massive automation and smart use of AI that will make it rather easy for most advisors to deliver amazing service to a larger number of clients without the need for many employees. Plus, it'll be more fun, according to Jason. Well, that's fun's a relative term. So the industry implications here, the deal signals a broader transformation in wealth management, where the lines between digital-first platforms and traditional advisory services are blurring. This convergence suggests that future success in wealth management may depend on firms' ability to combine sophisticated technology with professional advisory services, particularly as they target next-generation investors who expect both digital convenience and professional guidance. Next up, SEI to acquire tax optimization software provider LifeYield. Now, let me tell you an interesting story about LifeYield, a company that's been driving tax optimization and wealth management since 2008. Now, the company's founder, Mark Hoffman, is a serial entrepreneur who told me in an interview on our podcast, WealthTech Today, that his experience in electronic trading taught him a crucial lesson. Always ensure your systems can provide an answer to your client's most important questions. And these days, the most important question is, what's my tax hit? What's my tax impact? How do I minimize my tax footprint? And this philosophy led LifeYield to develop what they call tax smart software, tools that help advisors optimize their clients' tax situations across multiple accounts. Now, back in 2020, they made a significant push into API-driven solutions, which we love here at Ezra Group. It feeds right into our core message about better integrations across applications with our WealthTech integration score. And this API-driven solution mindset made their technology much more accessible to larger wealth management institutions. Then in 2022, LifeYield launched their multi-account UMA tax overlay service or product, which showed impressive results. According to an independent evaluation, that UMA tax overlay increased the investor outcomes by 33%. So big news there. LifeYield's approach has been unique. Rather than trying to solve everything at once, they broke down complex problems into what Hoffman calls chapters of a story. And this modular approach allowed advisors to tackle specific client needs over one at a time, whether it's Social Security optimization or tax-efficient withdrawals. And that technology over the years has led LifeYield to over $1 trillion in assets under advisement, assets running through their platform, and the news of SEI acquiring them. So SEI announced they're acquiring LifeYield. While the financial terms weren't disclosed, we know SEI is getting LifeYield's team of about 40 employees and their comprehensive tax optimization tech. The plan is to fully integrate LifeYield's APIs into the SEI Wealth platform, with future plans for a new front-end solution for both on and off-platform distribution. Of course, SEI is one of the very large company, one of the largest firms in our space and publicly traded. They custody over $1.3 trillion. However, only a very small fraction, under 100 billion, is on behalf of RIAs, according to the firm. And they've been making noise about getting more serious about RIA custody. There was an article in RIA Biz last year about how SEI wanted to get loud in the RIA custody space, specifically targeting Schwab clients who might be dissatisfied, unhappy with the merger with TD Ameritrade. And they're really going up against a lot of the other, I don't want to call them second tier, but up and coming tier custodians like Altruist, Apex, Goldman, of course, LPL, Trade PMR, AssetMark, Commonwealth. Now, SEI is also a TAMP and has a decent business there as well. And of course, a technology provider with their SEI Wealth platform and a trust provider with a very strong trust platform as well. So quite a lot of technology from them available and services available from them. So this tool of LifeYield should fit very well into multiple parts of their business, both on the tech platform side and on the TAMP side, and then that might even drive some work on the custody side. So why does this matter? The acquisition is significant for several reasons. First, it positions SEI as an industry leader, providing real-time automated UMH, Unified Managed Household capabilities, and a cost-effective bundled overlay solution. And what it essentially means is advisors can now look across their clients' accounts and implement tax-efficient strategies more easily than before. At least that's the goal. Now, timing is everything here. Of course, we're looking at massive demographic shifts with millennials and Gen X in their prime earning years, and baby boomers, halfway to retirement, or whether half of the baby boomers, or maybe 3/4, are already in retirement. As Hoffman shared in our interview on WealthTech today, younger clients don't want to be educated about Monte Carlo simulations or capital markets assumptions. They just want answers like, do I have enough money and am I safe? Now, when you consider that 86% of financial advisors see tax management as essential for their business, according to Cerulli, this deal directly addresses a critical market need. Now, LifeYield has a number of solid integrations, I think of over a dozen integrations last time we checked, and they have an Ezra Group WealthTech integration score of 6.24, which puts them in the excellent category there. So you can check them out. Check out their integration score at ezragroup.com. Some of the implications for advisors: this means that access to a comprehensive suite of tax optimization tools, everything from asset location, tax loss harvesting, to tax-efficient rebalancing and withdrawal optimizations, is now available, and under the SEI logo and with their financial backing. But it's more than just tools. It's now more of a systematic way to demonstrate value to clients. LifeYield introduced something which we thought was a very smart move, was the tax-efficient score. Tax-efficient, not tax-efficient, but tax-efficient score. And that kind of gamified their whole tax management process and evaluation. and helped advisors show clients concrete evidence of improvement in tax efficiency as the tax efficient score got higher with changes they made. So now with SEI's reach and resources behind it, that we should see that tax efficient score everywhere across the SEI landscape. And what's particularly interesting about this could affect advisors client conversations. As Hoffman also mentioned, they've learned to break down complex concepts into digestible chapters that advisors can use depending on where their clients are in the financial planning journey. So looking at the bigger picture, this acquisition signals a shift in how industry views tax management. It's moving from a nice to have feature to a core component of wealth management platforms. We're also seeing a trend toward what I call operational tax efficiency. It's not just about having a good tax management, not about having good tax management ideas. It's about being able to implement them systematically across thousands or even tens of thousands of accounts. This is where LifeYield's API first approach becomes particularly valuable, being plugged into the SEI ecosystem. And finally, this deal suggests that the future of wealth management technology will be built on modular API-driven architectures that can be easily integrated into existing systems. As Hoffman put it, they chose to be a software firm rather than trying to compete with their clients for AUM, and a strategy that's clearly paid off with this acquisition. You can learn more about them at lifeyield.com. Every RIA knows how important portfolio rebalancing is to their investment strategy. I can't tell you how many RIAs we speak to that aren't happy with their current portfolio rebalancing software. Now, this could be a standalone application or something built in to an all-in-one platform. But overall satisfaction levels are quite low. Now, our experience has shown that more than half the time, this lack of satisfaction is not due to any defects or missing features in the software. It's due to the lack of knowledge of the operations team and advisors in how to effectively make use of the software you have. How is your portfolio rebalancing software connected to other key systems? Does your team understand the myriad of configuration choices and options in rebalancing? How many custodians are you dealing with? And are you getting all the data you need from them? And is it being processed properly? If you'd like some assistance in answering these and other critical questions about your portfolio management system, you should run, not walk to our website, ezragroup.com, and hit the golden Contact Us button on the homepage. Our experienced team is ready to help you with any and all of your needs around portfolio management software, operations, workflows, and business strategy. Take your firm to the next level by working with Ezra Group today. In our next story, Orion announces an agreement to acquire Summit Wealth Systems. Reed Colley to join as president of Orion Advisor Technology. The wealth management technology landscape has been rapidly consolidating as providers seek to build comprehensive platforms that serve advisors' evolving needs. Orion has been a significant player in the space, offering a suite of technology solutions that help financial advisors manage and grow their practice. And they've also been an acquirer of a number of other firms over the years. Reed Colley's journey in the industry is particularly notable as the founder of Black Diamond Performance Reporting in 2003. He revolutionized how advisors presented performance data to clients through innovative graphical reporting and interfaces. After selling the business to Advent, and then which they merged into their Black Diamond product, which became their Black Diamond platform. Reed went on to found several other ventures, including Summit Wealth Systems in 2019. Now, Summit originally focused on streamlining advisor workflows while enhancing client experience and building out their own wealth platform to compete with the new Black Diamond, Orion, Tamarack, Advizon, and other RIA platforms. They're looking to target larger RIAs who wanted more sophisticated technology solutions. Now, Summit had made something of a name for itself, winning Wealthies Awards in 2022, 23, and 24 for their portfolio management platform. But as we will see, winning awards doesn't always translate into market success. So Orion has announced a definitive agreement to acquire Summit Wealth Systems, with the deal expected to close in early 2025. As part of the acquisition, Summit's CEO Reed Colley will join Orion as president of Orion Advisor Technology, reporting to CEO Natalie Wolfson. The deal includes Summit's 12 employees and its tech platform, although financial terms were not disclosed. We heard rumors that obviously since Brian McLaughlin stepped down, retired, He was the president of Orion Advisor Technology. There was a very active search ongoing. We'd heard a number of names floated around. So we're happy that Orion has found someone of Reed Colley's status to take over the Advisor Technology presidency. But what we had seen with Summit Wealth was not so much success as I expected, although we were certainly not optimistic, not because Reed isn't qualified or their team couldn't build. It's just that it's difficult to get traction on the enterprise side and replacing incumbent portfolio management systems, no matter how good your tech is and how good your team is. I wrote an article in 2020 called 50 Portfolio Management Systems Can't All Survive. And my point there was that there's 50 portfolio management software applications out there that do varying degrees of capabilities across an RIA tech stack, and they can't all possibly survive. They're all hanging in there, and they all see a lot of business for them because of the size and scope of the RIA industry. The 17,000 plus RIAs with many trillions of dollars. They all see it. Well, if we can just get a small part of that, we'll be successful. But it's just difficult to gain that traction because most of these firms are targeting the top 5% or 7%. I think 85% of the assets in the RIA space are in the top 8 or 9%. I can't remember the exact number of the number of RIAs. So you're looking at a very small number of firms that all have a portfolio management solution. And here at Ezra Group, one of our areas of expertise is converting RIAs from one portfolio management platform to another. And it's not easy to do. It's a big lift. It costs a lot of money. It takes a lot of time and effort away from your staff. So firms don't do it lightly. Especially when you're going up against the firms like Orion, Black Diamond, Tamarack, Advizon, who are very successful, have great platforms, and do very high client retention rates. Plus, they're locked up in 5-year plus contracts. So you got to hit the buying cycle just right. And also, we get a lot of these firms coming to us saying, hey, we're going to build this, whatever the tool might be, across the 50 different categories of Advisor Tech, and we're going to be better. Well, you can't just be a little better because, as I mentioned, the switching costs and the risks are really high. So you've got to be like 10 times better. And it's just hard to build anything that's 10 times better when it comes to portfolio management software these days, right? You can be 10 times better in artificial intelligence, right? We've seen that. But portfolio management is portfolio management. It's hard to get a 10x return on your investment. You're just going to get some percentage, whether it's 20, 30% return. You really need to be very tight with your expenses and very organizationally sound. So while they did close a few firms for the portfolio management platform, what we heard on the street was, that was taking them a while to get to parity, which is not surprising because these other firms have been in the business 20 plus years and they've been building those applications and the layers of functionality for that much time. So it's hard to catch up very quickly. So we had heard that Summit had pivoted away from portfolio management platform into more of a data aggregation system to be able to take post-reconciled data from your portfolio accounting system and then stitch it together for a better experience, which is all a great idea. More firms need that. But I guess they just didn't have enough time to switch their revenue model and close enough deals. And Reed saw it as better to sell out to Orion and consolidate there. So it could be a good deal all the way around. Reed gets something for the business, and Orion gets a very capable, a visionary type of leader who can run their technology platform, their technology business. So this acquisition is significant because it brings together, Reed and onto Orion, and Orion's one of the largest tech platforms, almost 5 trillion in assets on their platform, and he's a proven industry innovator with a great track record. So good addition to Orion's leadership, and signaling a strong commitment to technology advancement and advisor-centric solutions. Now, for advisors, particularly those using Orion or the few that are on Summit's platform, this merger promises enhanced capabilities. I'm sure there's something Summit has built, some of their capabilities Orion might be interested in enhancing their platform with. Orion's got a very capable platform, very comprehensive, but there's always room for improvement. And I'm sure Summit's got some smart people in their 12 employees that they can allocate to some areas of Orion to help that out. This acquisition continues a trend of consolidation in the space, although I think we could probably use some more. There's still too many products in some of these key spaces, especially around portfolio management, rebalancing. There's a lot there. I think that could be still consolidated. With 17 of the top 20 Barron's RIA is already using Orion technology. This just strengthens Orion's position as a dominant force in the wealth management technology space and can set a benchmark for integrated advisor platforms. You can find out more about them at orion.com. And next up, story is game-changing move in wealth tech. InvestCloud launches private market accounts. A wealth management first. So let's talk about some of the context here in this story. A recent survey by Cerulli Associates, alternative investment managers report sourcing approximately 13% of AUM from retail channels and expect that to grow to nearly 25% within the next 3 years. High net worth individuals are expected to increase their private equity investments by a compounded annual growth rate of nearly 19%, with global high net worth investors' commitments to private equity rising to 1.2 trillion by 2025. Clearly, the use of alternative investments in client portfolios is expanding at a rapid clip, and platform providers are noticing. They've been launching a variety of different solutions to enable advisors to support the use of alts in different client portfolios in different ways of doing this. Envestnet announced a partnership with UBS and iCapital to launch an alternatives exchange platform that's back in March of 2022. This is a platform that will be running alongside of Envestnet's tech platform, but with some integrations probably around reporting. So that's one way to do it. So they're running on the iCapital rails for the alts and then bringing it into a consolidated reporting solution in Envestnet. Halo Investing last year, it's still 2024, last year, 2023, launched a multi-manager structured note SMA marketplace. So Halo Investing, one of the first providers of structured note marketplaces, is now offering those inside of an SMA. Of course, that's only limited to Halo's network and only structured notes, but still a unique way of delivering alts into managed accounts. And then Orion also announced an alternative investment solution recently. And having the alternative investments in their platform as well is something that we're seeing a lot more across the industry. But this announcement from InvestCloud that they're launching what they're calling a private market account. So it's inside of a UMA. It's a sleeve inside of a UMA. And according to the firm, when you have this solution running, it's a dedicated sleeve for holding and managing alternative investments, supported by InvestCloud's EPL platform, one of the longest running and one of the first UMA platforms in the industry, which currently manages nearly 4 million models and over 3 trillion in assets. With this PMA account, why is everything MA, UMA, SMA, PMA? It's getting confusing. But with this PMA account, you can manage a variety of private market securities inside of a UMA, including private credit, private equity, real estate, operating companies, interval funds, non-traded REITs, and BDCs. Enables a holistic approach to asset allocation across public and private investments and have a single view and report of all investments in one place. Supports seamless rebalancing by managing the value flow between public and private securities and the complexities such as subscription frequencies, redemption frequencies, and liquidity gates. That's going to be complex. I'd like to see how that works. Discover and select strategists, home office, or asset manager models and products for inclusion into their PMA with greater integration and intelligence. Now, the firm InvestCloud foreshadowed this announcement back in October when they announced their dedication, rather they were focusing on alternative investments. Good article by RIA Biz. After a time of tumult's a good term for it, InvestCloud is divulging a reimagined business model where alts are the main course, but analysts are wary and that it's really just another TAMP. That's RIA Biz from October 2024. Jeff Yabuki, the recently appointed, he's been there a year ago, new CEO of InvestCloud, says that Naviplan and InvestCloud assets will come to bear in a grander strategy of the broader InvestCloud brand, focusing on alternatives. The essence of our strategy is the utilization of the significant data that underlies our broad set of technology solutions to enable our clients to deliver personalized, actionable insights and real intelligence to their advisors and customers when and where they need it, he said. Broader distribution of alternatives in a model-based environment is in the sweet spot of our business and one of several important use cases where InvestCloud can provide differentiated value to clients, financial advisors, and the end customer. One thing about the title of that article, RIA Biz, well, it's a great article. InvestCloud is not a TAMP. They are a pure tech provider. Right? A TAMP has technology, but they're also an RIA. They can take fiduciary responsibility for trades. InvestCloud made a strategic decision not to do that. They are a pure software provider. Now, their software can be used as the engine for a TAMP. It's currently being used this way by a number of their clients, but they are not a TAMP themselves. So, seeing what they've announced with this new PMA, there has been some negative responses we found on LinkedIn. So, one such response came from industry consultant Andrew Bashir. 4 years post-merger, the security APL trading connectivity assets are still an integration roadmap item for the InvestCloud Advisor desktop. You would think that this block and tackling would be the first priority as we get the existing models onto the desktops of their advisor clients. He also said, again, this is in a LinkedIn post by Andrew Bashir, implementing alts into this being APL's platform, is a whole different animal and presumably will require significant enhancements to the APL core. Do they have the resources to do this and integrate with the advisor front end? I don't know. The third part of his comment was, how does this impact Motive Partners holding in case? Will InvestCloud be competing with a sister portfolio company, or is there a way to combine the two to achieve the vision without causing unacceptable dilution to all the existing shareholders? Good questions, good comments. So I would say that they seem to have been doing a better job recently of integration and deploying of more of a holistic solution. Again, they were held down a bit by the previous management of InvestCloud. We didn't really understand the APL business, but I think Yabuki has managed it for many years back at Fiserv, so he's definitely more familiar with it. And yeah, there may be some competition with Case, right? Case has got a number of different offerings, and there might be some still understanding how this PMA is going to work. But Case has a marketplace where advisors can get access to different products offerings. So this sounds like it could overlap that, or maybe it could even be another option, right? So APL could say you can have our marketplace, or you can click here and get to the Case marketplace. There's no limit there. Even if they offer some, doesn't mean they can't offer more. But things like Case has also some SaaS software. Obviously, APL is also a SaaS product. So there could be some overlap in terms of delivery of the alternative investment operations and things like onboarding and account opening and reporting. There could be some overlap there with Case. But things like Case is a whole structured investment offerings and be able to build those bespoke strategies and custom funds that they can help you build. So InvestCloud I don't see them doing that. They might give you access to those, but they're not going to get into that business, I don't think. Now, this matters because for the first time, advisors can manage alternatives in a dedicated sleeve of a UMA alongside traditional investments, enabling true portfolio level integration. So on their website, key features include advanced analytics and insights, operational efficiency, tax optimization, and something they're calling the PMA network, which sounds a lot like Case's marketplace and iCapital's marketplace, connecting everyone, including asset managers, distributors, model producers, and wealth managers in a single contained ecosystem to make alts accessible within managed model-based accounts. So yeah, there could be some overlap there. Let me throw out some more negative comments here from Seth Adam Stewart, another industry consultant and investor. He put this out just last week. InvestCloud claiming industry first with their private markets account offering that can be rebalanced is more cloudy and foggy. It's a separate and independent sleeve, not a true traditional UMA. Due to liquidity constraints, product challenges, current investment structures, regulations, actual real-world rebalancing limitations, as well as tax management. So I don't think that's true. I mean, it's just because it's a sleeve doesn't mean it's not part of a UMA. Now, it's true that you can't just rebalance alternative investments when they are illiquid, and you can't do it as you would do a fixed income ETF or equities, where you could buy and sell them as needed and move money across different sleeves to rebalance. But you can still handle it if the UMA understands the capabilities or the limitations of the individual private investments. It can make recommendations as to, hey, this is growing too large. Maybe you want to try to sell some of these in the future when you're available to. If it understands the gating and other capital requirements of the individual investments, it could say, well, hey, you've got these investments in this sleeve, and it's grown. The valuation has grown above your target. We recommend you sell some of this, and of course, based on what we know about your holdings, you can't sell this until next year. There might be a reason. So it can still give it the recommendation, even though it may not be able to execute the sell orders. Something else Seth said: it's not just an accurate interpretation of the current market state. This seems more like a pure marketing announcement and is still being built and does not take into account these challenges, etc. As an FYI, InvestCloud had significant previous challenges when Motive Partners had to step in and remove most of the executive team and change their direction path. All right, well, that's true. They did that, but they brought in new leadership. Jeffrey Buki's been there for a year, and he's definitely changing things around and bringing in a whole new culture, from what I understand, talking to people who work there. So whether it's marketing announcement or not, we won't know until the first client goes live with it. They claim it's working, so we have to just take them at their word at the moment until a client actually announces that they've got it, or we hear from a client that they're using it. We won't know, but we will see. So why this matters? This launches InvestCloud's first major strategic initiative under Jeffrey Buki's leadership, and it positions the company to capitalize on the growing alternative investment market, which is projected to exceed $30 trillion globally by 2030. For financial advisors, this PMA account offers potential solutions to the long-standing challenge of incorporating alternative investments into client portfolios. Again, I'd like to see how things will work. Will there be any ability for the advisor to manage these investments and add to them or remove them or buy them directly? Or is it just going to be the home office that's handling it? Because again, remember, UMA is primarily a home office operational hierarchy and infrastructure. It's not really made for advisors to interact with, although firms like LPL and others have pushed APL and other vendors to give more access to advisors in a sleeve so they could do some of their own trading, an advisor traded sleeve, but wouldn't be able to trade things in a private account. But I'd like to know how it's going to work. Will it work like fixed income has always worked in UMA, whereas it's impossible to build a model of fixed income because of the many, many thousands of bonds. You can't just build a model of bonds. So usually fixed income SMAs, the managers manage them directly. So they log in and they'll make the trades in that particular sleeve directly, rather than the rebalancer being able to buy and sell those. So I imagine it'll be something similar, since no rebalancer is going to be able to handle the complexities of buying or selling private investments, but being able to have them in the same place, even inside the same account, is going to have some value. This announcement signals a broader shift towards democratizing alternative investments, though questions remain about the differentiation from existing solutions. With other firms, as I mentioned, InvestNet, Orion, Halo, also BNY Mellon, with their Wove platform, has announced some alternative options offering similar capabilities. InvestCloud's success will depend on its ability to leverage its existing market position and infrastructure to deliver a truly integrated solution. Again, that remains to be seen. The development also suggests that managed accounts may become the primary vehicle for mainstream alternative investment adoption, potentially reshaping how private market assets are distributed to retail investments. Curious about your thoughts. Please hit me up on LinkedIn or Twitter X at Craig Iskowitz. You can check out InvestCloud, more about InvestCloud solution at investcloud.com. And now it's time for my favorite part of the news. We're going to go over the AdvisorTech map and the WealthTech integration scores. I do this the WealthTech AdvisorTech map with the great Michael Keatses. Every month we go through new applications that are coming into our industry that want to get added to the map, and we debate them. It's a vigorous debate, discussions about these different applications. We talk about whether they should even be on the map at all. If they are, where should they go? What categories? Sometimes it's easy, sometimes it's hard. Sometimes we create new categories when new products come out. You can find the FinTech map on Keatses.com if you click on resources and then FinTech map, or just go to Keatses.com/FinTech map. Let's just jump right in. First application that will be added to the January map will be Advisor CRM. Now, we were questioning whether even the name is CRM. They do have a lot of portfolio management features. So we're trying to figure out where they should go. So I believe we're putting them into the CRM category with a secondary in the directory as portfolio management. But we need to get a demo and get some more information about Advisor CRM. You can find them at advisorcrm.com. They're also in the XYPN technology competition this year. They didn't win, but they were very good. It's a very good product. I like how they have really developed the application around the calendar of services that advisors provide to their clients. So rather than contact driven, it's calendar driven. So you should check them out at advisorcrm.com. Next up is Vantage Point AI. Does everyone have to put AI at the name of their product? VantagePointSoftware.com, world-leading AI forecasting software. So this is going under investment data and analytics. They claim 87% market accuracy, which Michael and I were a bit skeptical about. Their key features include AI-powered market forecasting and investment research capabilities. However, they do claim to have a substantial user base, so it's going under investment research. You can check them out, as I mentioned, at VantagePointSoftware.com. All right, so next one in the list. This is 2 months worth. We didn't have news last month, so I've got 2 months worth of applications. 2, 4, 6, 8. So this is applications that went into the December map and in the January map. Eight applications. Next one is Wavest. Wavest. Wavvest. I have to tell you guys, not the greatest name. Because when I saw it, I thought it's pronounced Wavest, and that's not a great name. I figured based on their logo, which looks like a wave, that it's a Wavest. But we do tend to have a bit of a laugh sometimes about company names and marketing. But Wavest. So we were still confused, even once we got to the website, what their core offering was. Is it software or is it a development service? And we decided it was software. The key features include AI-powered advisor platform and integration with various other services. And it's going under client portal is where Wavest is going. It's 2 V's, which is even more confusing. Wavvest, Wavest. And it is a client portal. Now another thing we always joke about is the combination of words or phrases, partial words that go into a lot of companies' names. The word future is a very popular name for wealth management products. Obviously, the word wealth is popular. The word advisor is popular, but also the word vest is popular. We saw Wavest just come out. And of course, we've got other vest companies, Vestmark, InvestNet, Vestwell. So lots of vesting, this and vesting that. There's another product that is being added to the January map called OneVest. And it's at onevest.com. Now they're a Canadian-based wealth platform, have a lot of traction in the Canadian market, and also have some decent funding. I think they recently did a Series A of $17 million to expand their capabilities. Primarily portfolio management tool, so it's going in the portfolio management category. They also have features like fee billing, performance reporting, digital onboarding, fee management, compliance tools, and a marketplace for advisors. So all those other categories will be secondary, with the primary being portfolio management. Check them out at onevest.com. Okay, I'm always a little skeptical about portfolio management tools. As I mentioned earlier in this episode, about 50 portfolio management systems can't all survive. And even Reed Colley coming into the market with a brand new product had some difficulty. So best of luck. Hopefully, OneVest can do it. Right, we always want more solutions and more options, but it's a very difficult road to break into the market. Ezra Group have worked with a number of Canadian companies, helping them understand the U.S. market and figuring out how to update and expand their offerings to be more competitive. So we do know a lot about that. All right, onevest.com. Next one is Millie. I's and L's just are hard to discern in the Arial font, right? I's and L's. When you see that in a URL, if there's I's and L's next to each other, don't do that. If you're trying to make a name of a company and you've got I's and L's in it, it's fine. Don't put the I's and L's together. It's hard to read in the URL or anywhere else for that matter. Millie, the website is getmillie.ai. So this is another AI assistant product, or rather an AI powered note taking tool that wants to go onto the map. They do transcriptions of client meetings and summarizing of those notes. It's another very difficult market to get into because of just how everyone has really plowed into this market after ChatGPT was released in November 2022. Everyone thought it was a great idea to do this, and there's so many also bigger players. Zoom has got their own Fathom, which we use, which is a plugin to Zoom for meeting notes. And lots of vendors are adding it. It's just so easy because you just plug in your ChatGPT or other OpenAI APIs or other generative AI tools, and you've got it. So it's really a flood. I mentioned earlier we had in the client meeting support category we had 4 applications 2 years ago, and now there's 15, including Millie. So good luck to you guys. Again, it's going to be very difficult to get some traction here, but you can check them out if you're interested at getmillie.ai. Next up, Interval. Oh man, they got a hyphen in their name. INTER hyphen VAL.ai is their website. Interval. This is an investment analytics tool that can analyze a client's portfolio and recommend individual stocks to buy in order to replicate the performance without having to buy ETFs directly. So it allows advisors to essentially create their own direct indexing strategies for clients without the high fees of traditional direct indexing services. So Michael thought this could be a useful tool for advisors who want to do their own in-house direct indexing rather than outsourcing it, since a lot of the direct indexing providers charge basis points, which isn't scalable and cost you a lot of money. And why not do it yourself? So whereas direct indexing providers were trying to disintermediate mutual funds and provide more value by giving advisors the ability to customize their indexes for a fee, of course. This company, Interval, is looking to disintermediate the disintermediators of these direct indexing providers by charging a SaaS fee, so a per user license fee, for advisors to be able to build their own direct indexing solutions in-house. So seems like a good idea. Interval, but bad name. Interval, INTER hyphen VAL.ai is where you want to go for that. Okay, so next one is Knomi, which is a behavioral assessment tool. It is also got an interesting way of spelling it, KNOMEE.com. Knomi, as in, hey, do you know me? It's a behavioral assessment tool that aims to help clients understand their financial personality and money habits. Now, we were a little skeptical about the business model of selling standalone behavioral assessments to advisors. Michael noted that we haven't seen much success in that category, even though there's like 15 vendors. It just that hasn't seemed to got a lot of traction, at least in the Keatsis tech survey that goes every other year. Not a lot of independent advisors are reporting that they are using any of these behavioral assessment tools, although they can be potentially useful for prospect qualification, since if you got a big pipeline and you don't know which ones are you really should be engaging with, you could use a tool like Nomi to better understand which of these prospects would be the best ones you should focus on. So if you're interested, it's Nomee, KNOMEE.com. All right. Finally, Pomeranian. Oh, I keep saying that. I apologize. It's Pomarium. I just called it Pomeranian. It's Pomarium. So it is, and the website is getpomarium.com. Pomarium transforms investment strategy into personalized stock portfolio. So very similar to Interval, does almost the same thing, where they say they're not a sub-advisor, they're a software platform. So you can build, again, the same thing as Interval, building your own mirroring of ETFs and mutual funds with individual equities using their software. You can do it quickly and easily. Now, they don't do any of the trading. They're not an outsourced provider. They just build the portfolios, which you can then send to whatever your portfolio management tool is. And they have listed that they support Orion, Black Diamond, Altruist, iRebal, LPL ClientWorks, Raymond James, SEI, Apex, and Envestnet. So it's a very, very strong list of portfolio management solutions that Pomarium integrates with. So again, this seems like a new category, although I think we're putting them into other because there is no category just for this, right? For this type of tool that does this capability. So it's going into investment analytics. Oh, this is going to investment analytics. Sorry. Investment analytics, investment data analytics tools where Interval and Pomarium, I'm having trouble, Pomarium are going to go. All right. So that's the roundup for the December and January Advisor Tech Map. You know where to get it. Let's talk about the WealthTech Integration Score. We recently launched our vendor portal on EzraGroup.com. If you are a vendor of any software in the Advisor Tech space, if you have an application on the Advisor Tech Map, you need to get your latest integration data updated on EzraGroup.com. You can go to EzraGroup.com/login if you're a vendor and register yourself to get access to the portal. That will allow you to update your integration data in real time, which will then, within 24 hours, update your score live on our website, which you can find at EzraGroup.com. You can find the scores to every one of 573 applications, what their scores are. The median score, which is interesting, is up to 4.35. I think it's up a bit from 4.2 just a couple of months ago. As more vendors are using the portal, updating their data, we're getting more data, more details, and the people's scores are rising because, again, we only have what's available on their website. So if you're a vendor and you've got more integrations that we know about, please let us know on our portal. And once your product hits a score of 6.0 or higher on the integration score, your product is eligible to join our WealthTech Integration Score Recognition Program. The Recognition Program is an annual program that gives you access to a number of benefits. One is you can use Ezra Group certified logos or badges on your website in your marketing materials, and that will promote your capabilities. You then also get access to private research webinars, some other information, access to our tech team or our integration team that can help you understand how our scoring works in more detail and help you scope out if you're building out more integrations, which one you should focus on first. We can give you advice there, and also discounts on Ezra Group Consulting. So you can find out more information. If you have any questions about the portal or the recognition program or about our WealthTech scores in general, please email us at integrations@EzraGroup.com. And you've reached the end of another episode of the WealthTech Today podcast. Thanks for listening. But before you go, please go to our website, EzraGroup.com. Scroll to the bottom of the homepage and sign up for our newsletter. Once a month, you'll receive an email chock full of wealth management goodness, news, information, and updates. You will not be disappointed. Thank you again for listening, and talk to you all again next time.